Welcome to Crowded Market Report by Jason Shapiro. To learn more about Jason and CMR, please visit www.crowdedmarketsreport.com or click in the right corner of this video.
Hello. Today is Sunday, October 1st, 2023, and I'm Jason Shapiro with CrowdedMarketReport.com. Yesterday, I recorded a video that was extremely bearish, and made the argument based on what I'm seeing, based on what I think the psychology is, based on where I think kind of is here, that could be a possibility, and given that possibility, there could be some huge payouts here on certain trades. Today's Sunday, the day after I made that video, so no data has changed. The markets haven't been open in that period. And what I'm going to try and do now is look at that same information and make the bullish argument, okay? And, you know, I've been doing this long enough and been on Twitter and all this to read comments of what people say. And, you know, what people are going to tell me is, oh, well, you make the bearish argument and then you make the bullish argument and then you come back after whatever happens and you say, oh, look how right I was. And that's really not the point here. In fact, the point here is pretty much the exact opposite, which is what I've always said was it doesn't matter if you're right or wrong. I could care less about being right or wrong. What matters in this game of trading the markets is making money, all right? And the idea of getting over being right or wrong is a very important aspect of making money over time, right? You're not going to be right or wrong very much in predicting the future, but you have to make money, so you have to trade the market as it trades. So one good thing to do is, okay, you've got this bearish view, you've got this bearish argument. Well, what's the other side? What's the bullish view? Because you have to be ready for it. Because many times what happens is not what you think is going to happen. And do you want to lose money? I mean, at the very least, try not to lose money when you're wrong, which is all about risk management. And if you're really good, make money and be wrong. Who cares, right? Like my clients don't care if I'm right or wrong. My clients care if I make money, clearly, and so do I, right? They don't come back at me and say, oh, you made 10%, but you were totally wrong. Okay, good for me, right? And they also don't come back and say, oh, you lost 10%, but you were totally right. Doesn't matter, man. It's all about making money. So let's try and make a bullish argument here based on the same stuff that I was so bearish about. So I think the crux of my bearish stuff has been based on the bonds and the fact that, you know, long end interest rates are going up because the Fed is not raising rates anymore, and therefore we're going to get a yield steepener. So let's say in the most bearish case scenario that's true, that rates are going up. Well, that doesn't necessarily have to be bearish, everything, right? We have had long periods of time where interest rates on 10 years were 7-8%, and the economy grew great, and the stock market went up, and everything was fine, right? That used to be the norm. It was only that we lowered rates to zero that became not the norm. I think that, so maybe we could just have economic growth, and that will justify the fact that the yield curve gets steeper, okay? And that economic growth can flow through to profits and all that. And I made the argument earlier in the year that with everybody expecting a recession this year so much, that maybe now that it's not come, and in fact demand is good, maybe they need to ramp up to catch up to the fact that demand is much better than they thought it was going to be. And if they ramp up, then we can actually get higher economic growth than people thought possible. Maybe that happens, right? If that were the case, then I would think, and obviously what's happened is that there has to be an adjustment period first where people start to freak out about the higher rates, and then they adjust and they say, oh, well, the higher rates are because there's better economic growth and better earnings, so we should actually be buying the stock market here, right? We're clearly going through that adjustment period now, if that's the case. And the first thing that would need to happen is you would want to see stocks be able to go up despite interest rates going up. And we actually had that a little bit this week. A very little bit, but Wednesday, you know, rates were making new highs and the stock market closed up on the day, right? So that's like sign one that maybe that could be happening. Now, on the other hand, let's say rates are going down, and I mean, rates are going up, and 6 months from now, they'll be much higher. Doesn't mean it has to happen tomorrow. Doesn't mean it has to happen this week. Certainly doesn't mean it has to happen at the rate that it's been happening over the last few weeks. We can see like 30-year bonds, for example. Okay, they're on lows here, right? But I mean, from March, you know, if I told you in March that 30-year bonds were going to be down here, that's one thing, but it was 6 months before they made lows, right? So they still made lows, but there's no reason why it can't hold. I mean, we're in pretty oversold levels here. The sentiment has gotten pretty negative here. I don't think negative enough, but it's gotten certainly some more negative. If in 6 months rates are higher, it doesn't mean anything for this week or this month or even, the next 2, 3, 4 months. They can hold here. And if they hold here, then maybe that's another way that you can start to rebuild people wanting to get into the stock market, right? And things don't necessarily have to crash, right? So the next thing I went to is the positioning on all that. Now, the most important thing to remember is that, and I pointed to these 30-year positioning, and that, sort of these small speculators were too long, right? First thing I will always say is that the COT is not a be-all and end-all predictor of what's going to happen, in particular on shorter-term time, right? Doesn't mean that bonds can't go up. I mean, here, this was April. The small specs were long, right? And in April was here. Well, kind of top there, but anyway, my point being, Mr. Traders is not the be-all and end-all. Doesn't predict, even when it gets it right, doesn't predict every tick, So bonds can kind of hold here. Now let's take it to the other extreme. Let's say rates are not going down or are not going up. Okay, well, then you can take that whole argument away. It takes a lot of the bearish issues away. If they can somehow, rates can stabilize here or even go lower. And how could that happen? Well, maybe the Fed can actually continue to raise rates, right? Because we get this, and therefore, if they are raising rates, it's going to keep the future expectations for inflation down, and therefore long rates don't necessarily have to go up so much. So that can be arguably bullish, right? And then the other things that I was talking about, like the safe haven stuff, where people were getting sort of super short the safe haven stuff. Well, sure, they're short the Aussie dollar, but again, and they're short the Swiss franc, but there's a lot more that could be, and yen. But you can see, even in this shorter period, they could be a lot shorter. Right? Which means that the dollar, look at the Swiss. I mean, yes, they're short, but they can be a lot shorter. So if they're going to get shorter, that stuff, then the dollar's probably going to continue up, and we're not going to get some kind of dollar devaluation or dollar crash, and that shows some signs of stability. So that can hold things together, right? So things don't necessarily have to be so damn bearish, right? And can arguably be bullish. A big story you hear is, the energies. Energy prices are going up, which is inflationary, and bonds are going down, and that's all bearish. Well, we know that the energies have gotten very crowded here, right? You can see where the spec longs are very crowded than crude oil. You can see where the spec longs are very crowded than heating oil. So there's an argument that, from a positioning point of view, energies could start going down. If energies start going down, and rates don't have to go up, then things can be okay, right? And you won't have to come in, and the Fed won't have to come in and do these bailouts and print more money and do QE again and have the possibility of blowing everything up because of that. A couple of the other things that could be bullish, and a counter argument to some of the bearish arguments I made, are, like, for example, this idea of AI, right? Which everyone has to talk about, but the idea that there's a shortage of workers and that inflation has to go up because wage inflation has to go up to attract workers. Well, there's a saying, necessity is the mother of invention. So if there's a shortage of workers, then it just makes AI that much more doable, right? You just replace the workers with computers or with whatever they do. And that can help, and that will help with productivity. And productivity is clearly a very important part of growth over time. It's always been the thing that has moved people ahead, right? It was much more productive when we had railroads. It became much more productive when we had cars. It became more productive when we had phones and fax machines and computers. And these were all big productivity jumps that helped increase valuations of the stock market in particular, and of companies, right? If you're making the same dollar for, 3/4 the cost, then, your price to earnings can go up. And that's what we've had over time. People are always complaining, oh, the price to earnings relative to history is too high. Well, if you continue to get productivity growth, then price to earnings should be higher than it was before, in my view. So that's another argument for how things could be bullish, despite what looks like could be extremely bearish scenario. So I just wanted to make one more observation about this, is in particular relating to the stock market and this whole bearish argument and what might not actually be so bearish. We actually have something that happened recently in the world in Argentina. What happens to the stock market if government bonds become useless, or valueless, and the currency loses its value because there's no confidence anymore, and the government has lost its ability to do anything, and printing more money just becomes a bad thing rather than a good thing. So this right here is the Argentine government bond. So it's yielding 49%. This is what's happened to the Argentine peso over the last 5 years. And the numbers are small to begin with, but essentially it's lost 90% than the last 5. And lo and behold, this is the Argentine stock market over the last 5 years. Chart right here, right? You're talking about something that's gone from, 18,000 to at its peak, over 60,000, right? And how can that be? We can all make up reasons in retrospect, but I would argue if the bonds and your currency become useless, what are people going to do with their money? They have to put it in something. Now, we can argue the place for that is gold. We can even argue the place for that is Bitcoin. But why not put your money into something real that has at least some economic value, like a company, like a stock? Would you rather, if the government debt is bad and the currency is bad, would you rather be in that, or would you rather be in something like, Apple or one of these companies has real assets that are worth something somewhere, right? And I think that's what happened here with the Argentine stock market. So just a thought on what could happen to the stock market. And why it doesn't necessarily have to be bearish of the stock market if all these other sort of horrible things happen. And the last thing that I would say about the bullish case is really just from the simplest thing there is. They say that sometimes the simplest answer is the best answer, and which is to say that things just do what they've always done, right? The world doesn't come to an end. Everything doesn't come crashing down, and the stock market just keeps working its way on its upward drift like it always has over time. And things are just okay, and that's really the high probability event over time and always has been. And I mentioned that in the bearish video that this is a low probability event, but it just happens at this point, based on sizing and stuff, to me, to be a high payout event. But look, a huge crash is always a high payout event if you catch it, right? So that's the point. Maybe it's just as simple as everything's going to be okay like it always has been, and people will figure out how to survive, and the stock market will continue on its upward drift. So those are kind of the counter arguments to what I was talking about in the bearish thing, and I wanted to do this specifically right after I did the bearish one, just to give the idea of you have to have both sides. And I'm sure people are going to come out and say, oh, you're talking out of two sides of your mouth. And, then you're going to come back in 6 months and you say, see, I was right. Not the point here. Okay. The point here is to get across the idea of anything can happen. All right. And you've got to be prepared for that. And you have to make money no matter what it is that happens. Who cares? Who really gives a hoot? Right? It's all about P&L. So focus on that. Focus on, okay, hey, here's the bearish argument. And if that's right, then the market's going to do this and I'm going to go with it. But if that's wrong, and in fact, it's more bullish than that, then here's what the market should do. And I'm going to go with that and just make money. And who cares? Okay. Be wrong. Make money. It's great. Right? Here I am sitting in my mansion. I've been totally wrong about everything, but all I've done is make money. Be that guy. Be that person. That's the one you want to be as a trader, right? So anyway, that's kind of the idea here. Hope I don't piss too many people off with that, which is a low probability, but hopefully it makes you think. That's all I'm really trying to do here, right? It's help people take a different view of how to make money in the market. Not about opinion, about trading the market that's in front of you as it trades, right? Okay, so thanks for that. I always say I'm always happy to hear questions or comments, but I'm scared on this one, but please send them along. And we hope to see you on crowdedmarketreport.com. And I hope everybody has another profitable week of trade. All right. Thank you.
Subscribe to Crowded Market Report by Jason Shapiro.